Hi, my name is Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I'm thrilled you're here. And I know that you're going to get tremendous value from the very knowledgeable gentleman that I'm interviewing today. His name is Mike Zlotnick, and he's the CEO of TF Management Group. He also manages funds, growth funds, opportunity funds, and through Tempo. Tempo is the name of the funds that he manages. And he's known as Big Mike because he's a big guy. And I think I'll leave it at that because he's got a very impressive and varied background. Welcome to the show, Mike.
Thank you, Rod. I appreciate your kind invitation. Happy to be here.
Yeah, absolutely. So why don't you, give a little better background? I know that you've got a bachelor's in mathematics, and you're a political refugee from the USSR, and just give us some background, some very interesting bio that I read. And so just tell us a little bit more about how you came into the fund business, the real estate business, and just give us a high level overview, please.
Thank you, Rod. I'll run through my life journey let's say 3 minutes or so. Just go through this stuff really quickly. So I immigrated from the former Soviet Union as a political refugee in 1989. It was still Soviet Union. I actually came from a Republic of Moldova, very small republic of the former Soviet Union. And I moved to Rochester, New York, upstate New York, and moved with my mother. And we settled there. My mother is still there. We are U.S. citizens now. We're U.S. patriots. Certainly have experienced socialism and as it's called, the evil empire. And you see how that world operates. And now Russia invaded Ukraine and the terrible impact on human life and so on. So United States is the greatest country in the world, in my view. I am I'm a big patriot. And for those who have not experienced other countries, this is a great place still, even with all the challenges and political issues. Now let's go back. So I came here in '89. I got my degree in mathematics from Binghamton University, and I went into computer science. I went into technology world, and I spent almost 14 years. And I discovered real estate in 2000 when I bought my first apartment in New York City. I live now in New York City. I've been in New York City since '96. To make real long story short, I've been buying apartments passively in New York City and some multifamily houses just as a passive investor from 2000 until 2009. 2009, I was done with my technology career. I had a very successful career, some technology exits, really enjoyed it, was grateful for that. But I realized my passion was always real estate. It was both you've heard of the concept genius zone. My genius zone has always been doing real estate business deals, investing in real estate. So in 2009, I went into real estate full-time. We launched our first fund, and we launched a series of funds ever since. So first, it was slow and grind, but we've learned and discovered a lot of things. We've done a lot of hard money loans. We've built a lot of finance expertise in debt lending. And 2017, we went full speed ahead on commercial real estate funds. So our journey has expanded quite a bit from there. We've launched Opportunity Fund, Growth Fund 2, Income Fund, and we've helped raise capital for a number of syndications in some multifamily space, shopping plazas, and so on and so forth. So I don't know how exciting that journey is, but we've had a great degree of success and a lot of fun doing it. And that's why I'm here. Happy to serve folks and happy to chat about what it is. And I'm a mathematician. I'm also a chess master. So I'm one of those geeks that spend my whole life sort of in exact sciences.
Nice. Yeah. So tell me a little bit about your team, Mike. What role do you play, and what are some of the other people on your team? Because obviously we all know this multifamily game is a team sport. And so how does that parlay into the fund component?
Sure. So we run our business fully outsourced. So we use third-party fund administrators, third-party auditors. So our own core team is only 10 people, but we utilize a lot of external counsel, a lot of professional fund administrators to help run that element of the business. So our job is to identify great operators, sponsors, who we want to invest with, underwrite them first, then underwrite their deals, negotiate terms, then we write checks, and then we manage the investments over time. And obviously, part of the game is also raising capital for our funds and syndication. So the team is 10 people, and we have heavy focus on asset management. 4 folks on the team are heavily focused on portfolio and asset management. And we have some technology folks. We have some folks in investor relations, marketing, and so on. But overall, I would say half the team is really driven by excellence in asset and portfolio management.
So help me understand something. So you invest in other operators, but you're actively involved in the asset management as well?
So let me take a step back. Our asset management is different from asset management if you are an operator. If you're an operator, your asset management is leasing, rehab, construction, property management. That's also asset management. Our asset management is understanding our portfolio. Where do we have investments? Where are the big checks or bigger checks? Where do we have concentration? Where we have risk? Where do we have big footprint? Visiting assets, spending time with sponsors, understanding how these projects are progressing. So asset management doesn't mean dealing with tenants and toilets and property management. It means managing the investments from a point of view of a capital allocator. Does that make sense?
Gotcha. Yeah, no, totally. And that hasn't come up on this show before. And guys, when I talk about asset management on the show, you hire a third-party property manager and you're managing that third-party property manager. So he's talking about it on a different level here, which I appreciate you clarifying. I assume you've got super analytical people that are analyzing deals or analyzing markets. So that's the asset management component is that they're analytical underwriters and so on and so forth on the team.
Pretty much what you said. So a substantial amount of it is analytical work. So underwriting, a lot of it is analytical pro formas. But at the same time, we do take out field trips. So we do want to see assets. We do want to see how they run. And seeing is believing. I don't know how much experience you've had working with, I'm sure you have a great amount of experience, but we come out and you see the difference between Class A or top of a line operator so let's just call them Class C operator, when the property is not as well maintained, not as well managed. So we certainly learn from our experience, and we constantly evolve and focus on working with people who are top operators, who know best practices in the acquisition, property management, disposition world, especially during these challenging days. Environment has changed. Right. It used to be easy to make money. Now we have to focus. So we are taking field trips. I'll give you an example. I took a trip to Indianapolis where we have a very big footprint, and we also went to St. Louis, spent time with the CEO of the company that's got a couple of $1 billion in AUM. We are one of the large investors with them. And spending time and understanding the assets, the numbers speak, but going on site at times adds a lot of value. We have other folks on the team who actually obviously visit these sites, but I want to come out myself, especially when we write big checks. So I don't know how best to explain it. When you look at a turnaround community in progress, where there were challenges in the past, some drug dealing, and you're turning around Class C community and you're making it to Class B, it's a heavy lift. And seeing just the occupancy numbers, if you're just going to do it based on a spreadsheet, you're going to see 30% occupancy, and you're going to start pulling your hair out. But when you go to the site, you see what's going on. You got rid of all the bad apples, and now it's smooth sailing, renovating, and then leasing up. And there's a waiting list of tenants because these units get Class A finishes, but they are Class C units. It's a remarkable transformation. So this is what I'm talking about: is making an impact, and being there sometimes helps.
Oh, no question. There's nothing like site visits. I'll tell you, just as an aside, I'm a little apprehensive about Class C units. Now, your scenario that you just described, where you're taking it and upgrading the class based on the finishes and the reposition, that's a different story. But just straight Class C units scare me right now. I'll be candid. With inflation as high as it is and gas as high as it is, I'm recently separated, and so I had to go buy groceries recently. And I went to the grocery store and I said, $150 for that? Are you kidding me? And it's like, I talked to the cook. I'm like, how do people afford this? And she just shook her head. And so, that demographic is getting their butts handed to them right now, Mike. So I'm kind of making a flight to quality. Or, I'll buy a C asset in a B area that we can upgrade, but I'm a little worried about C, definitely C minus and D. Those people are dying on the vine with this inflation. Do you agree with me?
Yes, agree 100%.
Yeah.
That's why we do Class Cs. Most of what we do are Class Bs. You don't want to be in a Class C in general. Unfortunately, inflation has been very hard for the folks that just make the ends meet. They don't have any disposable income beyond the necessities. And when the cost of necessities goes up, they begin to struggle. And I feel that pain, and it's a challenging demographic. And certainly you don't want to be investing in that part of the market, as it is very difficult lift. But from time to time, there is an exception. That project is an exception. It's a major reposition that'll basically, the area is actually B area. You drive around, you look at this area, it may look like an area. But the asset itself was a C asset in that area. That's the point.
I like that. I actually like that. You convert it, and if you've got a B area, you convert it. You just describe the finishes. To me, that's a home run all the way down the line. I saw a headline here. Actually, got it right here. Now, this is about 6 months old. And actually, I apologize, this is a year old, but I believe it's gotten worse. A year ago, there were 20 million U.S. households behind on their utility bills. And, that's when this whole inflationary run-up started. But, I think there is a lot of pain out there. But let me ask you this. Let me shift for just a minute. Are you involved in any deals with bridge debt right now? Because, when we were at the IMN Mid-Market Conference, I saw sweat beading on the foreheads of quite a few operators there that are in this bridge debt where, the rates have gone up, and they have, and loans are coming due. I mean, I guess there's 1.6 trillion in debt coming due by the end of next year. And at least $500 billion of that is multifamily. I'd like to talk about that a little bit with you. Your thoughts on, some of these distressed assets. I know you have a fund called an opportunity fund. We have a fund we're throwing out next week, an opportunity fund as well. Do you see some opportunity in that environment with these operators that got bridge debt? They're in, the water's going out. We're going to see who's naked once the water's all the way out at this point. I'd love your thoughts on that.
So if you remember my presentation at that conference where we chatted was, don't just survive an economic downturn, learn how to thrive. And the main point of the presentation is exactly that many deals have this type of a problem. And we do have investments. A lot of value add deals were bought with bridge debt. It's almost an industry norm. I don't know what percentage, but I've heard numbers, 95% of value add deals were bought with some kind of bridge debt. And when these assets come to basically from the time that they started a year and a half ago or 2 years ago until now, they've improved their occupancy. They've renovated these assets. Their rents are up 30%. Their debt service is up 100%, right?
Right.
So the pressure is immense. I'm completely with you that it's a race to refi. Yeah. There are 4 use cases, and I talked about them. If you look at your portfolio, every asset in your portfolio should be looked at, and you should look at these deals and the 4 primary buckets. One, you have bridge debt underperforming. That's the worst one. You didn't execute value add well, and you can't even refi. And you have a bridge debt maturing or rate cap expiring. This is a potential scenario. It can sink. This is the worst case scenario. And you need to know the difference between these key use case scenarios. Some are worth fighting and to survive, and some are just going to sink. Next case scenario, you have underperformance, but you got a fixed rate debt. At least you don't have that pressure. You just need to focus on potentially bringing additional capital to finish renovation well or changing the manager of the operation, but you don't have the debt pressure. Next one is you have a scenario where you have variable rate debt, so the payments are up, but you're executing well. So you're executing well, and you can finish renovation, and you can basically take the property through a agency refi. Fannie, Freddie, that point, the property can be stabilized. So the last two cases that I mentioned, they're worth the fight, most likely. You could have them survive. And then a beautiful case, of course, is you have fixed rate debt and a performing property, you have nothing, right?
That's the best, obviously.
But you got to think about all these. So my position on them is, of course, it's property by property analysis and razor focused on operating excellence. I really can't state that enough. So the path to sell or the path to refi is the same. You have to get the property to that 90% magic number occupancy. Once you get it there, you're in a beautiful position. You have options. Until you get there, you don't have that many options. Your only option to refi is another bridge loan. So we've seen some bridge-to-bridge refinancing. We've seen capital calls. They're still worthy projects. They just took longer. They overrun the budget. And a capital call, we've dealt with some of them. We've provided the capital. If they're worthy deals, of course we'll provide the capital. And then they're going through the drive to stabilization. Then we will have options. And some projects that are underperforming the game. This is what I started this whole conversation. It's all about property and asset manager. As a capital allocator, we put a lot of pressure on operators. If they're underperforming, we want to spend time with them. We want to both babysit them,
coach them,
and provide support. And if they need money, provide capital to make sure that. And if they are not right for the project, replace them. Politely ask them to leave. So at the end of the day, if you execute from operating perspective, you could deal with that bridge debt that's maturing, rate cap expiring, and so on. But if you can't execute well, then unfortunately you're in terrible shape. The other big question is, how well did you buy the property? If you bought it really well, then you have safety cushion. That example of the property that I mentioned to you, that is a 30% occupancy, was bought so deep that even with all the problems and getting rid of all the difficult tenants, the project will still be a home run. They just required additional liquidity to take it through the more difficult cash flow period of time of lower occupancy, heavier renovations.
Gotcha. So they did a capital call on that one. Gotcha. Okay.
Yeah, they had to bring in additional capital to solve it. On that deal, it wasn't even a capital call. It was more of an additional bridge debt. The property had enough room for kind of
that speaks to it. Yeah, if they were able to do that, that was a good deal. I mean, they bought it right. I will tell you, I work with an SEC attorney in Dallas that's huge in the business, and he told me half of his practice right now is capital calls, forbearances, and foreclosures. I mean, half of his business. So it's really, the what is hitting the what at this point, and the other thing that I'll mention is, with these people that can't refinance into conforming debt, they're in a world of hurt, because not only in most cases will they need to buy down the loan so a lender will even sniff the deal, but the rate caps are insane right now. I saw an article, this has been about 6 months ago, where if you wanted a $100 million rate cap, 3% for 3 years in 2020, it was $23,000. Okay, I mean, hard to imagine that. 6 months ago, that same rate cap, forget 3 years, for 1 year for 3% was $2.3 million. So it's not just getting the loan down to a debt service coverage ratio that works. It's also that rate cap, which is, and then we'll talk about sales. So they can either refinance or sell. Sales are down 75% as of first quarter this year. I haven't seen the second quarter numbers yet, but my guess is they're worse. 75% year over year decline. So I think there's going to be opportunity. I'd love your thoughts on that.
Yeah, agreed. In real estate, one man's trouble is another man's opportunity, and it's like, you don't want to think of it as zero-sum game, but sometimes it is.
Yeah.
So the best way to think about this, of course, as an investor, you have to be focused and support the assets that are strong and still worthy. But on the buy side, you're looking for deep discounts. There are no more good deal shopping. It's great deal shopping.
Right.
So the way to think about this is the way some of the discussions I've had with some of the top operators is they're talking to banks, they're talking to lenders, they're talking to insurance companies who provided them financing, and they know them as a high quality operator, asking the question, what problem files do you have? Oh, I'm in this market, I'm in Indy, I'm in Detroit, I'm in St. Louis. What other problem situations you have? And I would like to be the knight on a white horse to rescue. And they have the ability. But the situation with banks, you are 100% correct. They're beginning to see a lot of problems. And many operators are just not able to solve those problems. They can't raise the capital. The capital call is just not happening. So it become the defaults hit. Then what do they do with defaults? There's two possibilities. One, they want to take the asset. The other one, they play the game, extend and pretend.
Yeah.
I've seen enough
Yeah.
of that already happening.
Yeah, both are happening right now. And I'll tell you, if you're an operator and you're listening to this, you need to have complete transparency and be over communicating with your lender right now, because that's what they need. And you saw the Fed came out with that directive to be more pliable with, I think the word was credit-worthy borrowers, and be more accommodating. I don't know if you recall that note they put out, and so, they realize, and a lot of that debt, I think a third, some of these things that I'm throwing around, I've read, and who knows if they're completely factually accurate, but like a third of all of that commercial real estate debt is held by smaller and regional banks, and large banks as well. But there's a big component small and regional. And so, I'm wondering is if the Fed doesn't actually spend money again, which I hate the thought of because it's going to increase inflation, are we going to see more bank failures? What are your thoughts on that?
So your observation is exactly correct. Most of real estate has been financed with small and regional banks. Big banks play in this space, but it's not your traditional apartment complexes we're dealing with. Maybe $1 billion, $2 billion large buildings in Manhattan get financed by JP Morgan Chases of the world. Right. But other than that, a lot of them have been financed by regional and smaller banks. So the balance sheets have a lot of risk.
Right.
And banks are playing the game and they want to look strong. We don't want to have another March type of problem where multiple banks failed. They're certainly going to try to instill confidence, but behind the scenes, the system is very shaky. In addition to that, as 10-year Treasury continues to rise, the bank balance sheets continue to look worse and worse because they bought those bonds when the rates were very low per directive of the Fed. So they have really terrible balance sheets that they are trying to solve. Now they have access to the discount window and all that stuff. Meanwhile, the Fed is telling the banks tighten up the credit lending. They definitely want to tighten up the credit. They're fighting inflation in two ways. I know it's a deviation from your main question, but they're fighting inflation.
No, it's important.
Rate hikes, obviously, right? And the only thing they're controlling is Fed funds rate. And then they also have credit conditions and guidance to the banks, right? They do that as a way to also fight the inflation. So they're doing it to the best of their ability. And I think, honestly, behind the scenes, as much as they're saying and they're signaling that they may not be done hiking rates because inflation is sticky, behind the scenes, they're probably thinking when they can start loosening again. The reason for this is because they know these problems are brewing. They know that we might suddenly, usually these problems, they don't just happen gradually. Everything is normal, fine, good. It looks like there's no recession. Boom, we hit suddenly.
And there's a light switch. It's like a freaking light switch. That's what happened in 2008 and 9. It was like everything shut down overnight. I don't know if you recall that, but I don't know. You don't know my story. You'll hear it when I'm on your show, but I lost $50 million in 2008 and 9. And I was only at a 30% loan to value, and I still crashed and burned. I'll dig deep on that later. But yeah, it was like a light switch back then. And I think that could happen again. And we're just talking about multifamily. I mean, I'm sure you've seen what's going on in the office environment. I think the average occupancy in office in the 6 major metropolitan areas, the big ones, is like in the low 70s. And those assets they're all in default. So, I don't know, man. I think that we could be facing some serious headwinds economically as a result of, and it's being driven, in my opinion, not by the single family in the residential space like it was in 08-9, but it's being driven by the commercial environment. I don't know if you feel the same way or if.
Yeah, I don't like to use, I rarely ever curse. So the worst word is it's dog crap. Okay, pardon me.
Right.
Office space is the worst of all asset classes. It is massively dislocated by COVID. And I live in New York City. And I don't go to Manhattan often, but I have a lot of friends who work in Manhattan. And the story is like this. I work at Grand Central. My office building is right over the Grand Central. And you know what? Half the building is empty. Maybe they're literally, maybe figuratively, but the problem is broad and deep. Not only that, I speak with other business owners, and they are waiting to terminate their lease when their lease matures. They don't need the space they used to have.
Yeah.
So at this point, the demand for office space has been fundamentally dislocated. And that asset class is
big trouble.
In a very deep recession. Now,
big trouble. Yeah,
asset classes might hit the recession if things continue to go where they're going. But overall, we certainly we're not in a recession yet, but I am a believer that the recession has been delayed. And by the way, the reason the recession has been delayed is not that the Fed is not trying to induce the recession. They have been trying to reduce the recession, and they've done a lot of damage. But the projection has long and variable legs, number one. Number two, we're dealing with unprecedented unemployment picture. This low unemployment is so historically not normal that
it's unusual.
Exactly. Forcing a recession with this low unemployment is hard, but it's happening. It's going to happen over time. It's just going to take longer. So recession is coming, just not happening in 23. Probably we're looking at towards 24.
Yeah, and then the layoffs will happen and businesses will cut back, and that's all coming. I really believe that. But this is the June, July issue of Forbes, okay? And occupancy in office, they say it was 80% occupied in New York. Chicago was 73. Los Angeles was 73. But most of these other cities, San Francisco, 67. I think it's worse than this, honestly. Houston, 70. Washington, 78. I mean, none of these assets are performing. And so, if they're with bank debt, big trouble. And again, that's just office. You're not in any other asset classes, correct? It's just multifamily, no retail, no industrial,
no,
self-storage.
We have quite a bit of other. So we have brought.
Oh, talk about that. Talk about that.
So we have very little in office, thank God, right? And I can tell you one final comment on your comment on office space.
Yeah.
The occupancy may be 80% on paper because those leases haven't rolled yet.
Exactly.
Once they're going to roll, there's all kinds of downward pressure for the occupancy to drop. So now let's shift into other asset classes.
Yeah.
But we've done quite a bit. This is one of our major strengths. And I'm not trying to promote anything. We've done this because this has been my fundamental belief. I believe in the broad diversification. So we've done this from the very beginning. We've always tried to diversify across multiple asset classes within real estate, different locations, different operators, debt and equity. We've mixed things up. So what we like, obviously storage has been sort of a fundamentally solid asset class, has done well. We've done although I've been reading that just recently it's starting to slip, self-storage. I mean, I've been seeing some articles around that, and maybe you haven't experienced that in the assets you purchased, but I know a couple of my students who have thousands of units have complained about it. Has it slipped for you, or has it been fairly stable? We have not yet seen declines. Most of our investments in storage have been a few years out, and they were well bought. So we're seeing strong cash flows. Maybe the cash distributions growth is stalling, but at least we're not seeing any substantial issues yet. And you may be right that there are some issues brewing. Industrial or office flex, kind of a smaller / industrial, has done pretty well.
Love that space. Love that space. Yeah.
We've done also some shopping plazas. We absolutely love open air shopping plazas, and we've bought them very well. We work with the top of the line group that specializes in buying these properties. We did even an investment this year with them, a very substantial investment. They bought 2 shopping plazas, one in Fairfax, Virginia, the other one in Orlando, from a distressed REIT that was liquidating, publicly traded REIT. And the REIT had to liquidate. They looked over 100 assets, picked 5. They won 4 bids, and we looked at those, and we picked 2. So at the end of the day, it exists if you have open air, not enclosed malls, very different experience, right? You have very strong anchor tenant or set of diversified tenants. Ideally, you want to have a good anchor. If you have a strong anchor, that helps quite a bit. And obviously, the supply demand is critical in that area. A lot of shopping plazas have been around, but they haven't been built. So because of the fear of Amazon effect, of the e-commerce effect, investment has lagged. So what's really interesting is there's plenty of demand and very limited supply in the space. So high quality assets are very well worth if you can pick them up at the right price from a distressed seller. So that's my comment on that industry. We've also done a good amount of additional investing with folks who buy recreational land. It's been a very interesting story too.
Could you elaborate on what you mean by recreational land?
So normally land is infill, like you want to build, you want to develop multifamily property, you want to develop a house as an infill. So these lots, let's just call them commercial lots. They're used for some kind of real estate construction. It can be storage, industrial, multifamily, residential, anything. That's industrial or commercial land. The recreational land it's land in the boonies. People buy them to run their dirt bikes, to set up a shooting range to go camping. That land is not used as a it's typically not in big cities. It's somewhere away from cities. And folks buy it to own piece of their own America, to enjoy their own privacy. And that land is typically trades really, really cheap. So some of the folks we've done business with, they'll go buy a lot for cash for $4,000. They'll sell it on seller financing as receivables for $25,000. So we like some of those strategies because they're niche strategies, and there's no financing available. So seller financing $400 down $400 a month works really well. So
those are great plays.
Business and go ahead.
I'm sorry to interrupt. Forgive me. My friend Jack Bosch does that. You know Jack?
I know Jack really well. So
yeah, he's a great friend.
Jack is actually an investor in many of our deals. We've done quite a bit with Jack. So Jack is a close friend, and I know he actually educates folks how to do that. And yes, it makes a lot of sense. That business is very solid.
No, it's a good business. Good business. Yeah, he and I have been great friends forever. I think we've initially met at NMHC in 4 or 5 years ago, and been great friends ever since. He was in my mastermind. Actually, he was a member of my mastermind. So yeah, awesome. Well, so was there anything else? Recreational land, was that the extent of the additional assets?
I'm trying to think. There's some other niche strategies, but they're on a smaller scale. So obviously multifamily is a large footprint. We do, like, just to be clear, when we do multifamily, everybody has gone to Sunbelt. And I have nothing against Sunbelt. I love Sunbelt. We have some assets in Sunbelt. Generally, demographic growth, population migration, all those things are good. But we also love Midwest, steady Eddie markets. And there's a lot of value that you can actually add in those markets if you buy right. So again, multifamily is a great asset class, but you definitely want to operate in the business-friendly states and cities for sure.
Oh, no question. Yeah, I stay out of blue states. I mean, it's not political. It's just a cost of doing business and brain damage. But no, I love what you said, steady Eddie states. I like that because, even through the 08-09 crash, those states didn't suffer as badly. I mean, I saw a 70% decline in my asset value here in Florida in 2009 and 10. Okay. And of course, Vegas and California and Phoenix all got crushed as well. But the Midwest was, I love that, steady Eddie. It definitely was. So, I don't know if you want to, I mean, it's talked about quite a bit on this show here, but if you've got any insights as far as the value add component of what you do, is there any enlightenment there that you kind of spoke to it on that first deal you described as well. I'm
happy to elaborate. So folks have asked, so what do you guys do? I mean, what is your business? Like, well, why folks invest with you? And I just want to kind of explain the difference between direct operators and folks like us, right? So direct operators certainly have feet on the ground, they execute, and they often, the success or failure of the project depends on them. Our job is actually to pick some of these best operators. And a lot of folks out there, it takes years of experience and building these strong relationships to know the difference between the average Joe and the top Joe. And we focus on these relationships and we go deeper. So, and we allocate capital accordingly. We also have a bigger buying power. So when we come to a deal, and let's just say a sponsor wants to raise capital and they put together terms for investors, if they do sort of $100,000 investors, a whole bunch of them, it's a much bigger overhead for them, and they offer different terms. When we bring in a $10 million check, $15 million check, we generate substantially bigger economics, better economics for our investors. So our job is to negotiate better terms for our funds because we can bring larger checks, we can bring programmatic, systematic checks, we can also provide support when they have an issue. So it's a lot easier to work with us for many investors, many sponsors who are not in the business of raising capital from individual investors. And there are those people. There are plenty of folks that do both. They try to do individual deals and they try to raise capital. We love to work with folks who don't want to raise individual capital or as little of it as possible, and they want to get bigger checks.
Are you sometimes the only investor in a deal?
Sometimes, yes, exactly.
Okay, interesting. Now, you hear the term private equity. Would you be considered private equity in this regard?
Yes, we are a private equity provider.
Okay.
If you ask me what we do, we run family of real estate funds, but effectively what we do is also private equity in real estate. That's a lot of what we do.
Gotcha. Now, as part of that private equity, you hear some, and I've never utilized private equity. I'm the guy that does the 100,000 a pop when I syndicate deals, and I've raised, I don't know, probably all in, if I was guessing, close to 80 to 100 million. But on this private equity front, you hear stories about exerting control. What levels of controls do you implement, if any, when you invest in somebody's deal and you put a decent check in? Give me an idea of some of the controls you may implement.
Sure. So we're getting better at this, and this has been an evolving journey. So we've not had serious issues with most of the folks we invested with because they are top operators. So it becomes a tug of war how much control provisions they'll give you. So if you go to a top operator, they don't want to be removed from the deal. If you go to somebody entry level, they're so desperate for money, they'll agree to anything. So we're not looking for perfection, but we're certainly looking for folks that give us some language in case of certain default provisions. So for example, if they default on debt, we can remove them, right? I mean, there's certain control provisions.
Oh yeah, hello, of course, on that one. If they default on debt, good Lord.
But if they continue to run the project, we don't have the ability to generally remove them. But we definitely want ongoing reporting. We definitely want a number of provisions that in the operating agreements that were attorneys kind of inject as a secret sauce. Now it's all negotiated. It's not all or none. It's more like depending on each point, there's a little bit of negotiation. Yeah, this is acceptable. This is not. But within reason, we try not to be active operators because this is not our business. So we certainly want to pick and choose people who are very competent in the execution. But if they get hit by a bus and they don't have a team, and most people who we invest with, they have substantial teams, the organizations. We don't have that problem, but we insert control provisions to a reasonable extent without stepping on their toes. So it's kind of like, depending who your audience is, if they're entry-level operators, you have to have massive control provisions. If they're institutional quality $2 billion AUM, they're not going to give you heavy control provisions because they know what they're doing. And you can actually go through litigation. You can go through other sophisticated mechanisms if there's an issue. Most of the times, these issues are just solved without any heavy litigation. But we've seen situations where the sponsor wants too much, and at some point, you're just going to say, "Listen, thank you, but not no, thank you."
Right. By the way, guys, he says 2 billion AUM. That means assets under management for those of you that are brand new. And that's a large operator, obviously. I will tell you, we bought an asset in Lexington, Kentucky, beautiful asset that we went full cycle on, but the seller did not want to sell. He had private equity, was making him sell because it just fit their plan. That's why, I asked the question. Well, listen, I really appreciate you coming on the show here, Mike. And guys, if you want to check him out, it's bigmikefund.com. And he's also got a podcast called the Big Mike Fund on, I believe that's what it's called, right? Big Mike Fund on your podcast, which I'm going to be on. But listen, I appreciate you coming on, Mike. You've added tremendous value, and I look forward to reciprocating and seeing if I can add some value on your show.
Thank you kindly. I do like to correct this joke. Yes, the primary, our corporate website is tempofunding.com, but the easiest one to remember is bigmikefund.com. I know it's a little cheesy, but it's easy to remember name. That's why it's stuck. So bigmikefund.com. And if you forget the D at the end, or you misheard me and you forget the D at the end, and you just go to bigmikefund.com, I promise it's not a kinky site.
Thanks for coming on the show, my friend, and we'll talk to you soon.
Thank you, Rod.
So one other quick thing. We encounter so many people that are frankly frustrated. They're looking in the mirror and they're frustrated that they haven't been able to escape the rat race. They haven't been able to build cash flow to the point where they're able to have financial and time freedom with their families. And maybe they see other people buying real estate and creating, incredible cash flow, and they think, well, it's just scary. Buying apartments is intimidating. And I get it. But see, that's why we created our Warrior Mentorship Program. They're our coaching students, and they've had extraordinary results. My students, I've been teaching about 5 years, and they own upwards of 140,000 units now that we know of, right? And we feel like it's just getting going. Now, we're looking to grow this group and really take it to the next level. And honestly believe that the greatest transfer of wealth could be upon us right now with this current economic environment. Everything's going on sale. So we're looking for people who want to follow a proven framework, really like a blueprint or a map, literally step by step. And then they're able to leverage our systems and our incredible network to raise money and equity, to find deals and close those deals and build partnerships, really nationwide. So if you're interested in finding out more about how you can become more in our incredible network and take advantage of the unbelievable opportunities that are upon us, you can apply to my Warrior Mentorship Program by texting the word CRUSH to 72345, or you can go to mentorwithrod.com. And what we'll do is we'll set up a call so you can check us out and we can check you out and see if it's a fit. Now again, you can go to mentorwithrod.com or text the word CRUSH to 72345 to apply, and we will speak soon.